Up until now, we've established how banks measure, monitor, and manage liquidity under normal conditions. We've looked at internal pricing through FTP, regulatory metrics like the LCR and NSFR, and the governance and planning processes that tie it all together. But what happens when normal conditions break down? What if the assumptions that underpin funding strategies no longer hold, markets freeze, and clients start pulling out liquidity en masse? Now, in this session, we're going to focus on contingency funding plans, also known as CFPs, and how banks prepare to act when things go wrong. We'll explore what a good CFP looks like, how it's structured, what regulators expect, and how banks test and operationalize these plans. By the end, you'll understand how CFPs serve as the blueprint for survival during a liquidity crisis, and how they transform planning into action. Now, a contingency funding plan is exactly what it sounds like. A predefined strategy that outlines how a bank will respond to a liquidity stress event. Now, it sets out the actions a bank will take to preserve liquidity, maintain market confidence, and restore normal operations. Now, importantly, a CFP is not just a theoretical document. It must be realistic, actionable, and understood by the teams responsible for implementing it. Now, in a crisis, there is no time to figure things out from scratch. The CFP is the playbook. Now, the primary objective of a CFP is to ensure that a bank can continue to meet its obligations as they fall due, even if funding markets are closed, counterparties are nervous, and liquidity inflows are delayed or reduced. Now, it should enable the bank to weather an idiosyncratic shock, like a credit downgrade or a rogue trading event, or a market-wide event like a systemic banking crisis or a geopolitical disruption. Now, most importantly, the plan must cover both the technical and the human aspects of crisis response. So access to liquidity and the processes to get it, as well as decision-making structures, communications, and escalation pathways. So let's break down the key components of an effective contingency funding plan. The first element is a clear set of early warning indicators. Now, these are measurable signals that suggest liquidity conditions may be deteriorating. They serve as the trigger points for escalating from normal operations to contingency mode. Examples include a rapid decline in the LCR or NSFR, large client withdrawals, widening credit spreads, an increase in repo haircuts, loss of access to specific funding sources, or a sharp rise in collateral demands. Banks typically define a set of internal thresholds for each indicator. If a threshold is breached, this may trigger a predefined response, such as enhanced monitoring, liquidity committee meetings, or preparation to activate funding options. Importantly, indicators must be forward-looking, sensitive, and specific. They should be calibrated based on past stress events, tailored to the bank's business model, and monitored in near real time. Too many false alarms can erode credibility. Too few warnings can leave the bank unprepared. The second key element is governance and escalation procedures. The CFP must define who is responsible for what during a liquidity crisis. Who chairs the Crisis Liquidity Committee? Who makes the decision to activate the plan? How are decisions escalated to the board, and how are regulators informed? These are not hypothetical questions. They must be clearly answered in the plan. Now, roles and responsibilities must be assigned, documented, and understood by everyone involved. Now, many banks use a tiered escalation model, where different levels of stress lead to different levels of response. For example, Stage 1 might involve heightened monitoring and information gathering. Stage 2 might involve preparing liquidity actions and informing key stakeholders. Stage 3 might be full activation of the plan, including monetization of buffers, access to central bank facilities, or invocation of intragroup support agreements. Each stage should be tiered to specific indicators and have defined governance procedures. The third critical part of a CFP is the menu of liquidity actions. Now, this is the heart of the plan. A list of the actions the bank can take to generate liquidity in a crisis. Now, these actions are typically grouped into categories. The first category is the use of HQLA. The first line of defense is the bank's own buffer of high-quality liquid assets. Now these can be sold or used in repo transactions to raise cash quickly. The CFP should specify which assets will be used first, where they are held, how they will be mobilized, and who has the authority to act. The second category is access to market funding. Now the plan should list potential funding sources, such as secured or unsecured borrowing, access to commercial paper or certificates of deposit markets, and backup lines with counterparties. Now each source should be assessed for availability under stress, legal readiness, and expected capacity. The third category is use of central bank facilities. Now most central banks offer standing or emergency facilities that banks can use during liquidity events. Now these often require specific operational steps such as collateral eligibility, account access, or advance approvals. The CFP must document the process for accessing these facilities, including haircuts, pricing, operational cutoff times, and key contacts. Fourth category is intergroup funding. For banking groups with multiple entities, internal liquidity support can be a key tool. The CFP should describe intragroup limits, legal agreements, tax and regulatory considerations, and operational readiness for these transfers. Customer or balance sheet actions is another category. These include measures such as slowing new lending, tightening deposit pricing, or selling non-core assets. Now, while not always first-line tools, these actions can be useful to stabilize the balance sheet or send positive signals to the market. Now, each action must be described in operational detail. Who executes it? How long does it take? What are the risks? What systems are needed? What approvals are required? Regulators expect banks to go beyond generalities. The plan must show that the bank has done the preparation and can act under pressure. Now, next comes the communication strategy. In a liquidity crisis, perception is often as important as reality. A poorly handled announcement, a delayed update, or mixed messages can worsen the situation. The CFP should include a communications plan for internal and external stakeholders, employees, customers, counterparties, regulators, investors, and the media. It should identify spokespersons, draft holding statements, and define escalation channels. Now, the regulatory engagement plan is especially important. Regulators must be informed promptly of any material liquidity concerns, especially if the LCR or NSFR falls below 100%. The CFP should outline when and how regulators will be contacted, what information will be shared, and how follow-up will be handled. Now, for this, transparency and credibility are key. Firms that engage openly and early tend to receive more supportive responses. Now, another essential feature of a good CFP is testing. A plan that looks good on paper may fail in practice if it's not regularly tested. Banks conduct liquidity simulation exercises or dry runs where teams act out a crisis scenario, simulate discussions, and identify gaps. Now, these exercises test not just technical readiness, but also human dynamics, decision speed, clarity of roles, effectiveness of communication, and escalation flow. Now, test outcomes should be documented with lessons learned fed back into the plan. Now, testing is especially important in complex banking groups where liquidity may be dispersed across legal entities, jurisdictions, or currencies. A dry run can reveal operational delays, legal uncertainties, or coordination issues that would be fatal in a real crisis. It also helps build confidence among staff, ensures familiarity with the plan, and fosters a culture of preparedness. Now, CFPs must also be kept up to date. Markets evolve, business models change, regulators issue new guidance. A plan written 3 years ago and never updated is almost useless. Most banks review and refresh their CFP annually, or more frequently if there are significant changes. Now, this includes reviewing assumptions, updating contact lists, validating funding sources, and adjusting to new stress scenarios. Plans should be version controlled, board approved, and formally recorded. Now, regulatory expectations around CFPs have become increasingly detailed. In the UK, the PRA has issued clear guidance on what a good contingency plan must include, and supervisors review CFPs as part of the ILAP process. They may ask firms to walk through the plan in a supervisory meeting, justify assumptions, or demonstrate how the plan aligns with stress testing results. Weaknesses in the CFP, such as unrealistic actions, vague governance, or untested assumptions, can lead to remediation requirements or additional supervisory scrutiny. The European Central Bank and national supervisors across the EU have similar expectations. Under the single supervisory mechanism, banks must show that their CFPs are operational, entity-specific, and executable under stress. This includes evidence of cross-border coordination, local currency strategies, and robust documentation. For international banks, this means ensuring that CFPs are not only consolidated at a group level, but also tailored at the legal entity level. The ability to execute a plan locally in a specific jurisdiction with locally available tools is a key test of credibility. Now, let's not forget that liquidity crises are rarely slow-moving. They often unfold over hours or days, not weeks. Now, the speed of response is critical. A good CFP reduces decision time by pre-authorizing actions, clarifying roles, and anticipating obstacles. It acts as a force multiplier, allowing a well-coordinated team to achieve more in less time, under more pressure. Now, that is the essence of contingency planning, creating clarity in a moment of chaos. To sum up, a strong contingency funding plan is the cornerstone of liquidity resilience. It's not just about compliance, it's about survival. It links the analytical side of liquidity risk with the practical realities of crisis management. It ensures that buffers are usable, tools are ready, people know what to do, and decisions can be made quickly. CFPs build trust with regulators, with markets, and within the firm. In our next session, we'll explore another key element of resilience: liquidity stress testing. We'll go beyond regulatory requirements to examine how banks design their own stress scenarios, calibrate assumptions, and use stress testing to guide real-world decisions. I'll see you in the next session.